I'm going to give you three numbers right now. Put them on your screen. Number one, $68 to $71. That is the COMEX silver price today, Tuesday, March 31st, 2026, the last trading day of Q1. Number two, $78 to $82. That is what a physical silver buyer in Shanghai is actually paying right now today for the same metal after exchange premiums. Number three, $84. That is JP Morgan's own Q1 2026 target for silver, their own forecast, published by their own research desk for the quarter that closes tonight. Three different prices, same metal, same day, same planet. The COMEX says 68. Shanghai says 78 to 82. JP Morgan's own research said 84. The gap between what the paper market says silver is worth and what the physical market and the bank's own forecasts say it is worth has blown out to a level that I have never seen in my entire career tracking precious metals. The silver market is broken, not stressed, not volatile, not temporarily dislocated. Broken. The price discovery mechanism that the entire global silver market depends on is producing a number that no longer reflects the actual cost of acquiring physical silver anywhere on Earth. And today I'm going to prove it with 5 specific pieces of evidence, each one independently verifiable, each one sourced from official data, and each one pointing to the same conclusion. The COMEX paper price is a fiction. Proof number 1, the Shanghai premium. The Shanghai Gold Exchange, which is the primary precious metals exchange for the world's largest silver-consuming nation, is currently pricing physical silver at a persistent $8 to $12 premium above the COMEX paper price. As of this week, Shanghai silver is trading at approximately $77 to $79 per ounce in USD equivalent terms based on the yuan exchange rate conversion. But that is just the exchange price. Chinese buyers also pay a 13% value-added tax on top of the exchange price. When you add the 13% VAT to the $8 to $12 exchange premium, the effective delivered cost for a Chinese buyer acquiring physical silver right now is approximately $80 to $85 per ounce, against a COMEX paper price of $68 to $71. A $14 to $17 gap between the paper price and the actual cost of physical acquisition in the world's largest consuming market. That gap has persisted for weeks. It is not a one-day anomaly. It is not a temporary arbitrage opportunity that market forces are correcting. It is a sustained structural disconnect between what the paper market says and what the physical market charges. And the reason the gap persists, instead of self-correcting, is that the arbitrage mechanism is broken. Under normal conditions, when a premium exists in Shanghai over COMEX, traders buy cheap COMEX metal and ship it to Shanghai to capture the spread. The metal flows toward the higher price until the gap closes, but China's export licensing regime on silver prevents metal from flowing freely into the country through normal trade channels. Shanghai inventory has collapsed 43% in 3 months, from 559 tons to 318.5 tons, the lowest since 2015. The supply pipeline into Shanghai is constrained, while demand is accelerating with Caixin Manufacturing PMI hitting 51.2 for March, the 6th consecutive month of expansion. Supply shrinking plus demand growing plus trade barriers. Preventing arbitrage equals a permanent premium. The gap cannot close through normal market forces because the normal market forces have been disrupted. When the physical price in the world's largest consuming market persistently exceeds the paper price by $14 to $17, the paper price is not reflecting reality. The physical price is the real price. The COMEX number is something else entirely. Proof number 2, JP Morgan's own Q1 forecast. This is the proof that should make every silver investor stop and think about what the COMEX price actually represents. JP Morgan, the largest precious metals bank on the planet, the institution with more influence over silver futures than any other single entity, published their 2026 silver forecast in February through their global research division. Their Q1 2026 target was $84 per ounce average. Their Q2 target is $75. Q3 is $80. Q4 is $85. Full year average $81. Q1 closes tonight at approximately $68 to $71. JP Morgan's own forecast for the quarter that ends today was $84. The actual COMEX price missed JP Morgan's own target by $13 to $16. The bank that operates the largest silver trading desk in the world, the bank that has the most sophisticated precious metals models, the most data, the most market intelligence, the most trading infrastructure, published a forecast of $84, and the market they operate in delivered $68 to $71. There are only 2 explanations for this. Either JP Morgan's research team is incompetent, which nobody who understands Wall Street believes because their metals desk is the most respected in the industry, or the COMEX price is being influenced by forces that are separate from the supply-demand fundamentals that JP Morgan's models are built on. Forces like commercial short positioning at 201 million ounces. Forces like CME margin hikes that forced leverage liquidation. Forces like Q1 window dressing and options expiry pinning. Forces that have nothing to do with how much silver exists, how much demand exists, or what the metal is actually worth. Greg Shearer, JP Morgan's head of metals research, stated that silver's fundamental deficit has existed basically since 2021, and that structural drivers remain that may continue to constrain supply. He is telling institutional clients that the deficit is real and the supply constraints are real. His own model says $84 for Q1, and the market delivered 68. Something is broken between the model and the price, and the something that is broken is the price discovery mechanism itself. Proof number 3, the 21-to-1 paper leverage. The Bank for International Settlements, the central bank of central banks based in Basel, Switzerland, published their March 2026 quarterly review. In that review, they confirmed that the paper-to-physical leverage ratio in the silver market stands at 21-to-1. For every single real physical ounce of silver that exists in the system, 21 paper claims have been created. 21 paper contracts, each one representing a promise to deliver 1 ounce, stacked on top of a single real ounce. This is not COMEX-specific data. This is BIS global data encompassing all exchanges, all OTC markets, all derivative instruments linked to silver worldwide. The entire global silver market is leveraged 21-to-1. When you look at a COMEX silver quote of $68, that price is being discovered in a market where 21 paper ounces trade for every 1 physical ounce. The price is set by paper trading, not by physical transactions. And paper trades are dominated by institutions who can create contracts out of nothing with no obligation to ever touch a real ounce of silver. They sell paper silver. They buy paper silver. The price moves based on their paper transactions, and the physical market, where real people pay real money for real metal, has completely disconnected from that paper-derived number. A market with 21-to-1 leverage is not a market discovering the price of a physical commodity. It is a derivatives market discovering the price of a financial contract. And the price of a financial contract can be any number the largest participants want it to be as long as they have enough capital to maintain their positions. The COMEX price is the price of a silver financial contract. It is not the price of silver. Proof number 4, the U.S. dealer premium spread. You do not need to look at Shanghai or BIS data to see the disconnect. You can see it on APMEX right now, OpenJM Bullion right now, check SD Bullion right now. A Silver Eagle is priced at $13 to $15 above the COMEX spot price. Generic rounds carry $5 to $8 premiums. 10-ounce bars are 4 to 7 over spot. Even the cheapest, most basic silver product you can buy from a U.S. dealer costs $4 to $8 more than the COMEX paper price. That means a real American buyer paying real dollars to acquire real silver is paying $72 to $79 for metal that the COMEX says is worth $68. The street price has already broken from the paper price within the United States. You do not need to reference Shanghai or Tokyo or Mumbai. The disconnect exists at your local coin shop. It exists on the website you check every morning. The dealer is not overcharging. The dealer is reflecting the actual cost of sourcing physical metal in a market where COMEX is not being replenished from Mexico due to cartel violence, where Samsung has locked up mine output through direct deals, where shipping insurance through the Strait of Hormuz is essentially unavailable, and where the Silver Institute has confirmed the 6th consecutive year of structural supply deficit at 67 million ounces. The dealer premium is the market's way of telling you that the COMEX price is wrong. When premiums expand, the physical market is saying the paper price is too low. Premiums are a correction mechanism. They exist because the paper price has diverged from the real cost of acquiring metal. And right now, those premiums are elevated, persistent, and showing no signs of contracting. Proof number 5, the CME margin hike intervention. In January 2026, silver ran from approximately $70 to its all-time high of $121.67. The move was driven by physical demand, supply deficits, geopolitical risk, and speculative momentum. It was a genuine bull market move supported by fundamentals that JP Morgan's own models predicted. And when it crossed $100, the CME group raised margin requirements. This is confirmed by CoinDCX's March 31st, 2026 report, which states that CME group raised margin requirements sharply when silver surged above $100. Higher margins forced leveraged long traders to either deposit additional capital immediately or liquidate their positions. Most retail and small institutional longs liquidated. They did not sell because they thought silver was overvalued. They sold because the exchange changed the rules mid-game and made it too expensive for them to hold their positions. Silver crashed 44% from 121 to 60. The crash was not caused by a change in fundamentals. The deficit did not suddenly reverse. Industrial demand did not suddenly collapse. The COMEX vault did not suddenly refill. The crash was caused by a rule change at the exchange that forced selling from participants who were leveraged long. This is the same playbook used in 1980 when Silver Rule 7 restricted trading to liquidation only. The same playbook used in 2011 when margins were raised 5 times in 8 days. The exchange waits for the price to rise on genuine demand. Then it changes the margin rules to force liquidation. The price crashes. The shorts cover at the bottom. Physical delivery is taken at discounted prices. And the cycle resets. A market where the exchange can change the rules whenever the price moves too far in one direction is not a free market discovering a fair price. It is a managed market producing a managed price. And the managed price is $68 to $71, while every physical market on the planet pays more. Now let me quantify the total disconnect across all 5 proofs. COMEX paper says 68 to 71. Shanghai Physical says 78 to 82 before VAT, 80 to 85 after. JP Morgan's model says 84 for Q1. US Dealer Retail says 72 to 79. India says 82 to 83 at MCX conversion. Tokyo All-In Retail says 107 to 127. BIS confirms 21 to 1 paper leverage globally. CME confirms they raised margins to force the price down from 100. Take the average of every non-COMEX price reference point. Shanghai 80, JP Morgan 84, US Retail 75, India 82. The average across these physical and institutional price points is approximately $80 per ounce. The COMEX says 68 to 71. The disconnect is $10 to $12. That gap represents the difference between the paper-derived price and the physical reality price of silver as of today. $10 to $12 multiplied across the 1 billion ounces of silver traded annually represents $10 to $12 billion of value that the paper market is suppressing relative to physical reality. That suppression benefits commercial shorts, holding 201 million ounces of short positions. Every dollar the paper price sits below physical reality is $201 million of profit protection for the short position holders. The Silver Institute's 6th consecutive year of structural deficit means supply is not catching up. Samsung locking up mines means industrial demand is being secured outside the exchange system. New mines not producing until 2033 means no supply relief for 7 years. Mexico's cartel crisis means 28% of global production is at risk. China's export controls mean the largest consumer is hoarding. London's LBMA vaults down 40% since 2021 means Western reserves are depleted. COMEX registered down 38% since October means the delivery mechanism is failing. Every physical data point says silver should be priced at $80 or higher. Every paper mechanism says 68 to 71. The paper mechanisms include 21 to 1 leverage, CME margin interventions, Q1 window dressing, commercial short positioning at 201 million ounces, and options expiry pinning. The physical data includes structural deficits, vault drains, exchange premiums, dealer markups, and corporate mine lockups. The paper market is not discovering the price of silver. It is manufacturing a price for silver. And the manufactured price diverges further from physical reality every week. As the vault drains, the premiums widen, the deficits persist, and the supply constraints tighten. Goldman Sachs targets $85 to $100 silver. Citi targets $110. Bank of America's range reaches $309. Every research desk that models physical supply and demand produces a number above the COMEX price. Because the COMEX price is not a supply-demand output, it is a derivatives market output. And derivatives markets reflect the positions of their largest participants, not the physical reality of the commodity they reference. The gap between paper and physical will close. It always closes. Throughout the entire history of commodity markets, when a persistent gap opens between the paper-derived price and the physical market price, that gap closes in one direction. The paper price rises to meet physical reality. Physical reality does not drop to meet the paper price. That has never happened, not once, in any commodity, in any century. And when this gap closes in silver, when the COMEX paper price finally catches up to the $80+ physical reality, the move will not be gradual. It will be violent. We are talking about a $10 to $20 repricing that could happen in a single session when the dam breaks. Q1 closes tonight. Q2 starts tomorrow. The window dressing pressure lifts. Fresh capital enters. The April delivery cycle is live. Liberation Day tariffs hit Wednesday. The Iran deadline arrives Sunday. And the most broken silver market in modern history is about to enter the most catalyst-loaded week of the year. The COMEX price is the price they want you to see. The physical price is the price the market actually believes. The gap is $10 to $12 and widening. When it closes up. Stack accordingly. I will see you in the next video.